It is the Silver Dollar Academy. Today, we have with us one of the best, most knowledgeable professionals on the 1031. I'm Scott Stevenson. I am also known as the Silver Dollar Man. We'll get into that some other time. But for today, we've brought to you Alan Stallings from Olympus 1031. He has over 40 years of experience in the real estate industry. We're really happy to have him. I've heard his classes before, tremendous knowledge and background. So without further ado, Alan, come on down.
There could be a little more further ado. I wouldn't mind. Okay, this is going to be interesting. I'm used to a big crowd stadiums usually. Like Scott said, I've been in real estate for 40 years. I'm fairly new to 1031 exchanges, only about 25 years in with 1031 exchanges. So I may make a few mistakes, but probably not. I am a lifelong resident of Salt Lake area, and spent a couple of years teaching overseas with my wife, but pretty much I'm a Utah native. But real estate has been my passion for the last 40 years. Just before we get started, feel free to, and I don't know if you have the ability to ask questions by typing, or if you want to raise your hand and unmute, but questions are good. There's a saying that says there's no such thing as a stupid question. That's one of the dumbest things I've ever heard. We've all heard stupid questions, right? And so hold your stupid questions, just ask the really good questions. The reality though is that unless you get involved, it really doesn't stick. And involvement, if you have a question and you say, well, I don't want to appear stupid, guess what? The person in the next frame has the same question. So feel free to ask questions. We'll kind of vote on whether it's a dumb question or not as we get going. And then before we get started too, it's like anything else in real estate. If you're selling a house and your client says, what do you think, Dion, about the roof? Do you think good roof? Do you think it'll last for a little while? What is your response to that? I don't mean to put Dion on the spot, but your response is and should be, well, I'm a real estate agent. I'm a professional real estate agent, but I'm not a roofer. I could refer you to a roofer if you're concerned about it. Okay, it's the same with exchanges. Okay, you're not a professional when it comes to exchanges. Guess what? My response is the same. Even though I know more than most CPAs about 1031 exchanges, I'm still going to use the line. You know what? I'm not a tax attorney. I'm not a CPA. So if you have questions, you probably want to involve your CPA or tax attorney. Okay. Why do we do that? Like with everything else, the roof and plumbing and everything else, it is to make sure that we take responsibility for what we do and limit the responsibility for what we shouldn't do. In this case, neither you nor I are the professional when it comes to 1031 exchanges. The other thing with 1031 exchanges is you don't need to know everything. This is going to be a crash course on exchanges. You will leave here with a fabulous tool that will help you sell more properties. And there's some really great benefits to working 1031 exchanges that we'll talk about. But you will leave here with that knowledge. Now, the knowledge isn't quite as important as leaving with my contact information. General understanding of why and what, but it's, you know what? You probably got to talk to Alan, and he could maybe explain better than I could how a 1031 works and how it could save you some tax dollars. Okay. So the most important thing on your handout is my contact information. So that down the road, when you say, I think I remember how that works, but I'm not sure, let's call Alan. Okay, that's probably the most important thing. Now, anybody know what a 1031, why it's called a 1031 exchange? Cammy, you know why it's 1031?
Zero.
Okay,
Zero.
most of us don't know a 1031 exchange is kind of a weird name for a program, but the reality is it is a section of the IRS code. Section 1031 of the IRS code deals with tax deferred exchanges. Now, tax deferred, and that's critical, a tax deferred exchange is not a tax free. A lot of people think, well, a 1031 tax free exchange. That has been in the vernacular for years and years and years. It's a misnomer. It's not accurate. It's a tax deferred exchange, which is key because as we learn with the statement that nothing is certain but death and taxes, you will leave here understanding that we can actually defer and possibly avoid, no, you can't, it's a felony, I think, to say avoid paying taxes. You can minimize to the point of zero your exposure of capital gains taxes, and we'll talk about that. But death, I still haven't gotten that one down yet as far as how to avoid that one. That will be a future class. All right, so to understand a tax deferred exchange, you kind of have to understand if you don't have this vehicle. And I understand that they're mulling over the possibility of getting rid of the 1031 exchange. I think that would be a dramatic or drastic mistake as far as our real estate market and the economy, but we won't go there as far as the political aspects. But understanding if we don't have the exchange, what happens? Okay. As you probably know, and this might be a little bit basic as far as just tax, how taxes work. But if I purchase a property, and hopefully you can see the numbers if I put up here. If I purchase a property for $100,000 20 years ago, and today it's worth $300,000, basically if I sell it, I pay taxes on $200,000. Okay, that's the basic, very basic. Now, there's other things that come into play with this scenario that we'll talk about in a second, but that's basically what we're looking at. All right. What this is called is the basis. It's kind of what we're into the property, how much money we've spent in capital improvements, what we paid for the property, and including our closing costs and so forth. That's our basis. All right. And then the net sales price of what we sell it for, the difference between our basis and that net sales price is our tax liability, our capital gains. Now, what is the capital gains tax currently? And it depends on what tax bracket you're in, but I like to say worst case, because a lot of times when you're selling a big asset, you're going to bump up to the highest tax bracket. I don't think there was advertised in the brochure that there's math involved in this class, but so I apologize for the math. But right now, it's anywhere from 15 to 20% federal tax on this long-term capital gain. Now, if I own this property for less than a year, then it's basically ordinary income is what I'm taxed on, which could go up as high as 40 in the 40%. But if I hold it for more than a year, it's considered long-term capital gains, which is a huge distinction because you're looking at 15 to 20 versus in the 40s. 20 is kind of what we'll go off of. In Utah, bless our hearts, in Utah, we get another almost 5% added to that. So we could be as high as 25% in paying taxes on our $200,000. I know you're smart enough to figure out 25% of $200,000 is going to be $50,000, right? And correct me, jump in if I make a math mistake. But I don't know about you, and I love this country as much as anybody, probably more than most. And so I want it to be solvent. I want it to keep going. But I just assume not pay $50,000 of my hard-earned money to Uncle Sam. Okay. But if I just outright sell this property that I've held and pay Uncle Sam, I could pay up to $50,000. All right. To me, that's a lot of money. I know to Dion, that's not a whole lot of money. She's got that much in her mattress, under her mattress. But to me, that's a lot of money. And so what a 1031 exchange does is it allows us to, instead of paying that amount of money, it allows us to go ahead and sell the property. And instead of taking that gain, I can defer that. I can put that into exchange. That's why it's called an exchange. I can exchange that into a different new property. Now, where does that gain go? It goes into the new property. So just again, to go through a little more in detail as far as how this works. If I buy it for this, now, one of the reasons we get an income or investment property, and that's the only thing that this works on. It doesn't work on your primary residence, doesn't need to, because tax-free with the 250 per person, as you know, 500 per married couple, the tax-free is a little bit better than tax-deferred in my book. And so we always, in fact, just a little side note, the first question I always ask your client is, have you ever lived in the property? All right, a lot of people have lived in the property, and then they turn it into a rental. And then for 2 years, they decide, nah, you know what, I really don't want to keep this as a rental. And so they come to me and say, I want to do a 1031 exchange. Now they've lived in it for 3 of the last 5. They've rented it for 2 of the last 5. Do they qualify for the exemption? The free, tax-free? And the answer to that is yes. It doesn't have to be the last 2. It only has to be 2 of the last 5. And so in this case, even though they've rented it for 2 years, I will say, you know what? You don't need to do an exchange. All you need to do is sell it, and it constitutes, as long as you haven't done another primary residence within the last 2 years, it constitutes a primary residence, 250 per person, 500 per married couple, tax-free of this gain that we've been talking about. So that's the first thing. I try to eliminate, try to help your client. Now, it hurts my bottom line because then I don't get to do an exchange, but the right thing to do is to save them the tax-free instead of just deferring it out into the future for some future point to pay the taxes. So any questions on the tax-free versus the tax-deferred? Okay, you want to be the monitor if there's.
Let me see if there's.
I've got a quick question. So you said if as long as it lived in it 2 of the last 5 years, and you didn't buy another principal residence. So if you moved out of the home 2 years ago and bought a new principal residence and then waited 2 years to sell, then you couldn't use that exemption.
Okay, so the scenario is, I don't know if everybody heard, the scenario then is, I lived in this house forever. I rent it for 2 years. Well, when I move out, I buy another primary residence. I rent this house for 2 years. What are my options? And as long as the new house I'm living in now, I don't want to take that exemption in the next 2 years, then I come back to my rental and I've lived in it for 2 of the last 5 years, I can still treat that as my primary residence. Now I have to stay in my primary residence, my current primary residence, for at least 2 years before I can do that again. And I don't know if anybody's old enough to remember the old primary residence tax treatment. I think it was, you had a one-time $120,000 exemption on your gain on your primary residence. All right, and you needed to replace it with another primary residence. That's gone away with, I don't know, a decade or so ago, to where every 2 years you can sell your primary residence and not pay taxes on the gain up to the 250, 500,000. Did that answer your question?
Yeah. So basically, as long as you've been in it for 2 of the last 5 years, you can sell it no matter what and not have to pay taxes on it, correct?
Right, up to those limits, correct.
Got it.
Yeah. Okay, any other questions before we kind of leave the general treatment of house versus income property? All right, so why in the world would you want to own income property? I normally ask, how many of you, by a raise of hand, how many of you own income property? Okay, quite a few of you. Why do you do that? Just for the fun of kicking tenants out and cleaning messes and, yeah, no. I had some evictions that I had to do that were not pleasant. It's just not a good thing. Why do you do it? You do it for 2 reasons.
I think there's 4 reasons to own rental properties. I think a lot of people have probably heard of this. There's appreciation of the property itself. There's mortgage pay down by the renters. There's cash flow after you pay your bills. And then the last thing is tax advantages like depreciation. Those are kind of the 4 main ways that you get financial benefits from owning properties.
Perfect. And that's exactly right. Those 4 things are the reason we go through the hassle of being a landlord. All right, we're hoping for appreciation. We're counting on depreciation every year on our taxes, an income stream, and appreciation of the property, I think was the 4th. All of those things are important. So how that works is we buy it, let's say our basis, this is what we're into it to start with. All right. And I know this is a math simple, but not realistic in today's real estate market. There's, I don't know too many real estate transactions that are $100,000, but we start $100,000 and then our basis, which remember our basis is critical because our basis determines our tax amount at the end of the day when we do sell it. All right, so the basis, do we want the basis higher? Do we want the basis low? We want the basis as high as possible because the difference between what we sell at our net sales price and our basis, that's the taxable capital gain. So we want the basis as high as possible so that that gap is as small as possible that we're paying taxes on. That's why you write off, when you do any maintenance, any repairs, you write that off, usually in the same year. Now, in a major event like a roof repair or a major remodel, the IRS wants you to capitalize that and take it over the life of the property. And so how that looks is you start out depreciating that. So let's say after 5 years, your basis is down to 90,000. And the basis is only calculated, or the depreciation is only calculated off of the structure, not the land, because land apparently doesn't depreciate. So we depreciate and we've deducted, off of our taxes. Now our basis is $90,000. Now we put a new roof that costs $20,000. So we're back up to 110. And then we depreciate some more next 10 years or so. And now we're down to 80,000. So you see the basis is going to be a little bit of a roller coaster with a trend going down, just because we're using that tax advantage of depreciation every year. Okay, don't hesitate to stop me if you're not clear on how this all flows, or ask the question and Cami can kind of come back. Okay, so the base is kind of up and down, and let's say we sell it and our basis is $80,000, but we sold it again for $300,000. So let's say 380,000, that makes the math a little easier. All right, so our capital gain again is 300,000. 25% of 300,000 is, I don't even want to calculate it, but it's substantial. Okay, so that's kind of how the flow works. If we pay taxes, that's a huge tax. And has property appreciated at all in Utah? I know if you're representing a buyer, you realize that it's crazy. Well, sellers too, with multiple offers and above list price, values are going through the roof. And so if you're selling a duplex or a rental or even raw ground or a commercial property, it's crazy as far as your tax liability has climbed, exponentially almost. And so this is kind of the negative. This is kind of what happens if we don't utilize a 1031 exchange. All right.
I have a question. You said that you can count closing costs. So I'm actually looking at doing my first 1031 exchange possibly. And I've cashed out refinanced twice. So I can count both, well, 3 times counting the initial purchase. I can count all of those closing costs back into the basis.
As long as you haven't, and I apologize, I'm off the screen because I can't hear it unless I'm over by the TV monitor. It depends, you can't count it twice. And so if you've deducted those closing costs off the yearly taxes, which a lot of people do, they because deducting it now versus in the future, adding it to your basis is preferable, as long as you can get away with it. That doesn't sound good. As long as you're aggressive. If you're aggressive, most people are aggressive on their taxes and will deduct each year all that they can. So if you've deducted those already, then no, you can't add it to your basis. If you haven't deducted it, yes, you can add that to your basis. Okay. And that brings up a very important point that let's talk about right now for a second. The exchange and the basis and your tax liability is a completely different thing than your financing. All right. If you refinance and pull money out, it doesn't have any bearing on, other than closing costs, it doesn't have any bearing on your basis or your taxable liability. All right. So a lot of people say, well, I only got 200,000 out. So that's all I have to replace. Well, no, it doesn't matter. I had one that the person had to come to the table with money to do the exchange. They didn't have any money because they pulled it all out in refinances. And so just keep in mind that the financing is a completely different plane than the tax liability. Okay. So just the basics. We've talked about it cannot be your primary residence. It has to be an income or investment property. All right. Oh, there's one more thing before we leave the normal. Anything that you've depreciated, and not to get too CPA on you, but anything you've depreciated is a different tax bracket or a different liability, and that's called recapture. So you have your 20 in Utah up to 25%. You also have a 25% federal recapture tax on all the depreciation you've taken on that property. All right, in an exchange, that's deferred as well. If you pay your taxes, then you pay the 2 different tiers, the capital gains tax and the recapture tax. All right, love talking taxes. Actually, I love doing exchanges because it kind of messes with the IRS. We're with hopefully no, I have a hard time teaching this class up in Ogden where there's a lot of IRS agents that are also agents, real estate agents. And so I have to be a little bit careful how I badmouth the IRS, but I love messing with the IRS. Okay, so the process, let's talk about the process, how it all works, because that's where it's kind of been made to sound a little bit mystic and a little bit tough. It's really very simple. We're going to simplify the whole thing. And the reality is for you, the agent, what a 1031 exchange is, it's a sale and it's a purchase. All right. That's all it is. It's a sale and a purchase. And it depends on your broker. Some brokers require the 1031 addendum that the state has come out with. That's great. Is it necessary for the exchange? No. Is it necessary if your broker says it's necessary? Absolutely. But as far as you're concerned, that might be the only thing that you would, the only additional issue that you would have to address in selling a piece of property. You might want to add it to your listing. Okay, seller is doing a 1031 exchange. Again, up to your broker. My personal feeling is if somebody doesn't understand something, they might not. In today's market, maybe it doesn't matter, but in a normal market, if I'm limiting my pool of potential buyers because of something that the agent or the client doesn't understand, 1031 exchange, I don't know what that is. I've got 3 other properties I want to make offers on. I probably won't make offers because I don't know what that is. All right, you don't need to put it in the listing. The buyer doesn't even need to be aware of it. They sign a document at the end of the day saying that they did it. If they don't want to do that, they don't even have to do that. We can just send a notice saying that they participated. So as far as disclosure goes, not a big deal. All you're doing is selling the property. All right. In fact, there have been cases where, quite a few cases, where we're sitting here at Title I, or I'm not. I'm in my office and I get a call from one of the escrow officers here at Title I, and they say, these clients who are sitting at the closing table just talked to their accountant and decided they should be doing a 1031 exchange. It's like, oh. Now that freaks out the escrow officer. They'll give me a call and say, hey, how quick can you do this? And most of the time it's right away. I'll put it together. I'll create the documents, send it back over. They retweak their closing documents and we make it happen as far as the 1031 exchange. So a lot of times you as the agent don't know that your client wants to do a 1031 exchange until it's right up until the closing. So don't freak out thinking it's too late. It's almost never too late until it's recorded to do the exchange. All right. So let's walk through just kind of how it works. And then we'll get into the actual rules. And they're, again, fairly basic, not a big deal as far as the rules go. Okay, you have a listing. Let's say you've got, let's be a little more realistic. You've got a $600,000 duplex. All right. Let's say you've got they still have a $200,000 mortgage. And they go to closing. And let's say this is our net. And so the proceeds would normally be $400,000. We won't talk too much about the basis because we've already beat that to death. But there's probably a fair amount of taxes that would be paid here. And a lot of times I'll talk to the client and I'll say, okay, when did you buy it? What's your basis? If they know the basis, if they don't know the basis, I'll just say, what are you into it? How much did you buy it for? How long ago? And if the basis is really high and they're not making that much money on it, quite often I'll say, yeah, you probably don't need to do this. Your tax liability is so low. But anymore with the appreciation we've seen, pretty much it makes sense to almost everybody. But our net amount, let's say, is $400,000. All right. So we close that. Now, normally that $400,000 would go to your client, your seller. All right. And the seller likes that number as high as possible, right? They want as much as possible. In an exchange, one of the cardinal rules of an exchange is that the taxpayer, the seller, cannot touch the money. Okay, that's a cardinal rule. Whatever money they touch, they pay tax on. Okay, Write that down, underline it, highlight it. That's critical. Any money they touch, they pay tax on. And that's not only touching physically, that's constructive receipt. If they have control over the money, it's constructive receipt, they pay taxes on it. All right. So what happens to that money? And that's where the 1031 comes into play, that the 1031 requires an accommodator. Now there's a bunch of names. I've been called a bunch of names and some of them have been nice, but most not. But the exchange company, accommodator, facilitator, has to come into play to be the intermediary, all right, to be the go-between. And at that point in time, and exchange companies vary a little bit as far as what they do with this. Quite often they just throw it into their big bank account and let it sit there. My exchange company, we set up a separate individual bank account for that money. They're federally insured, sits in that bank account, okay? So that money would come to the 1031 company to hold on to. Again, your client is not touching the money. All right, so it's in my bank account. Now your flyer says that it's in an interest-bearing account. Now that changed a little while ago. So cross out interest-bearing, or not cross it out, just put non in front of interest-bearing. Because now it's in a non-interest-bearing account, because the taxpayer, if they're getting interest on that account, the IRS says, well, you have constructive receipt if you're getting interest off of that account. And so we stopped doing the interest on the account and it just sits there. All right. Now, one of the great things with the exchange is that quite often when you sell a house for a client, you're done, at least until they get ready to sell, or one of their kids or neighbors or somebody that they refer to you, you're kind of done with that client. The cool thing for you as an agent is, in an exchange, guess what they have to do? They have to replace that asset, that house, that duplex in this case, with another property. If they don't, they pay the taxes. And so you're almost guaranteed, unless they go out of state or, you know, do something funky in Guam or Puerto Rico, you're almost guaranteed at least 2 transactions, the sale and a purchase. All right. How does it get any better than that as a real estate agent? That you get 2 for, it's like a BOGO, a buy one, get one. You sell one and you get to represent them always on the purchase. A lot of times it's like, well, I'll let you know when I'm ready to buy. All right. And then you hope you hear from them. In this case, they have a very tight time frame that they have to do this replacement. And so they're Johnny on the spot. In fact, we'll talk about some ways that you can speed that up even, especially in today's market. But that money goes into the account, it sits in the 1031 account, and then it goes into the next transaction. Now, the second cardinal rule, besides, what was the first one? That's right, you can't touch the money. The second one is equal or greater. I guess it should be, it's been so long since I've done the alligators. I'm still going to do it that way. Equal or greater value. All right. Now, this is where a lot of people say, well, my value is the 10. So this is what I need to replace, is the 400,000. No, because we talked about cash out refinances. That number could be virtually nothing. And that doesn't work as far as the IRS. The IRS is looking at this number right here. All right. Not after this, just this. So this is what you have to replace, the 600,000. Now it's a little bit, it helps a little bit that it's net sales price. And what does that mean? Net sales price means it's minus commissions, minus closing costs, minus taxes. It's basically what they get plus the payoff of the mortgage is the number that has to be replaced. All right. And please, questions, if you don't understand that, you know, stop it and we can go through it a little more. in detail, but the bottom line is I have to replace this plus this, which equals my net sales price. Okay, so I have to find something at least 600,000, and it could be any number in addition to that. All right, so I find me a nice $650,000 property. Now what happens? Again, if I cannot touch the money, this whole amount goes into this transaction, which leaves me 250 short. It used to be that one of the cardinal rules is that I had to replace the debt. All right, which for all intents and purposes, we do. All right, but I don't have to. Let's say I won the lottery last week and it was only a $500,000 lottery. And I want to, instead of getting a loan for the difference, I want to come out of pocket with the 250 difference. I can do that. All right. Most people don't win the lottery. Surprise, surprise. And so they are getting financing on the $250,000. All right. So I get financing on the two together with my 400,000, and I buy this new property. All right. Simple. And that's how 90% of the 1031 exchanges are. I sell one property, I buy a property equal or greater value, I'm done. Other than reporting it on your tax return. I report on the tax return that I've done the exchange. Okay, that's the basic. Now let's as far as
Alan, I have a question for you.
You bet.
So when you say net sales price, did I hear you say that you can subtract your mortgage? So basically on this scenario, you would technically be at 400 minus, let's say, a 6% commission at 36,000. So that puts you like at 364. You would actually have to purchase a property equal to or greater than 364. Would technically
no. Thanks for clarifying. No, what it is it's the net sales price, and the net sales price doesn't count the mortgage. Okay, I don't get to deduct the mortgage. So it's basically the proceeds plus the mortgage is what I need to replace. Okay, but I get to deduct the commissions, the closing costs, the property tax prorations, pretty much everything other than the mortgage I deduct off of that gross sales price to get the net sales price.
Got it. Thank you.
Any other questions? Good question. Thanks. Okay, so this is the standard. Let's go through some of the rules and then we'll apply it to some different scenarios really quick. All right, we've talked about the first cardinal rule. The first cardinal rule is the money, you cannot touch the money. All right. The second cardinal rule was equal or greater value. Now, the equal or greater value is an aggregate. So it's, if I sold my 600,000, I could buy two 300,000. Okay, I could buy 6 100,000. All right, the number of properties does not matter, only the value. And we talked about, Jessica talked about the net sales price is what we use on the replacement value. Fortunately, we get to count the gross sales price on the purchase. All of our closing costs and everything else on the purchase value. So we kind of get the best of both worlds, net on the sale, gross on the purchase. But it doesn't matter how many properties, it only matters the value of the properties. Okay, are we all clear on that? All right, so the next cardinal rule is The type of property, okay? It's called like kind. That's what the rule, the section in the IRS code says, I need to replace it with like kind property. Now, it's kind of a misnomer there because the reality is like kind, you would think, is like kind. If I sell a duplex, I should buy a duplex. It's really way broad in the fact that it's like kind means any real estate. Any real estate, with two exceptions. The only two exceptions to any real estate are that it cannot be my residence, either primary or secondary. Okay, vacation home, that doesn't work. What if I'm using it personally, it doesn't work. And we can, in a little bit, I'll show you how to get around most of that, because that's what the IRS code, right, is all about, is getting around the code. Nobody's taping this, are they? but the reality is the first exception to the any property is it cannot be for my personal use. Can't be my primary residence. You don't want it with the 250, 500, and a second home, vacation cabin, something. There's some rules on that that restrict that quite a bit. The second exception is that it cannot be my business. And what I mean by that, if I'm a developer and I'm buying a piece of property and then I'm subdividing it and then I'm selling it to builders, I cannot do an exchange because that's my business. If I did an exchange and then sold the lots, did another exchange, bought some more property, developed it, did the exchange, or a lot of builders, you know, they buy a bunch of lots and then they sell the houses, and I can't do it if that's my business. If I'm an investor and all I do is buy a piece of property and sell it, buy, sell, buy, flip, buy, flip. But again, I have an investor now that is doing it the right way that can do that as his business. And we'll talk about that in a little bit as well. But those are the two basic rules as far as like kind property. So the bottom line is, if I sell my duplex, I can buy raw ground. If I sell my duplex, I can buy a retail, warehouse, office building, whatever, as long as it's real estate. Now, the kind of not on the edge, but on the safe side of the edge, is a lot of investors buy a tenant in common property. So they don't even own the whole property. They only own 10% of an office building in, you know, Milwaukee, Wisconsin, or whatever. Okay, as long as I'm buying real estate that's not my primary residence, that's not my business, as long as I'm buying real estate, as long as my name is on the deed, it works as far as like kind property. Okay, which is great news. That just opens up the possibilities, you know, almost endless as far as what they can do, what they can buy as a replacement property. All right.
Alan,
The next
can I
is,
ask you a question?
you bet.
So, if you're doing one and build a home on it, are you allowed to include building materials in your 1031 exchange?
Okay, that is a great question. So you're building a home as an investment, right? It's not for you to
Yes.
live in. Okay, so I'm building a home to rent it out.
Correct.
I have a bunch of these going right now in Park City. It's like they're buying a $1.1 million lot to put a 350 or $3.5 million house on it to rent it out. It's like, okay, I want that market. So the answer to that is yes. The answer to that is yes. There's the jury's still out. One of my tax attorney buddies says that you can close on it and keep funding. So let's put it into numbers to make it a little more, Josh, a little more understandable. Let's say we buy a piece of property for 500. We need to replace $1 million, right? And so the rest of that million, the other 500, is going to come in improvements, whether it's fixing it up or whether it's building from ground up. I need to put that much more into it. one of my tax attorney buddies says we can go ahead and close on this and just fund it like a construction loan after the fact. The way I read the code, I actually set up normally what's called a construction exchange. And this is off in the weeds a little bit, so if you need to go get a drink, if this isn't something you want to learn about, but a construction exchange is where to buy this lot, okay, I would set up, that is the accommodator, I would set up a single purpose LLC. I would take title to that lot. I would use the rest of your money to build the house on my lot now. So now your client would be covered with a recorded trust deed and note that says, I can't go to Mexico owning your piece of property. So there's protections, but I own this. They put the improvements in, and then within the time frame that we'll talk about in a second, within the time frame, then once the value has increased, then I will deed it to you as the second leg of the exchange, okay, at the higher value that it needs to be. Does that make sense, Josh? Are we okay? Does that answer?
Yeah, I think so. So one more thing is, would that create an issue with your timeline on the 1031? Would you run out of time for your purchase properties if you didn't get started on this before the sale?
Yes, that's the biggest detriment to a construction exchange is the time frame. And let's go ahead, and it'll probably make sense if we jump right into the time frame then. And let me just tell you, there's really, well, let me badmouth the IRS just a minute. Most of the code does not make sense. If you ask why questions to the IRS code, you're just going to get frustrated because there's no why. There's no rhyme or reason to most of the code. And that's the same with the 1031. So the first time frame is you have 45 days from the closing. Now, this is a pet peeve I have in Utah, and having been in title and real estate, I'm guilty of this as much as you are. But what is the closing? It's not the signing, it's the recording, right? We sign and then we record. Sometimes we record the same day we sign, which is great. Then we close the same day. But the closing is recording. Now, why is that critical? Because the IRS is lazy like the rest of us, and they want the easiest way to trip you up on your exchange so that you have to pay taxes. And so a public document is going to be the easiest way they can verify whether you fit into this rule. All right, so you have 45 days from the closing or recording to identify what you're going to buy. Okay, nothing is sent to the IRS. There's no, I mean, there's records. You need to have some evidence, but it's just a silly, stupid rule that has no meaning, no rhyme or reason. All right. Then you say, how do I identify? What are the rules for identifying what I'm going to purchase? And the answer to that is there's three options to identifying a replacement property. All right. The first, which is used 99% of the time, is you have three properties, up to three, unlimited value. Okay, so if I need to replace $600,000, the sky's the limit. I can identify one, I can identify two, I can identify three, I can identify as many as I want to. Well, as value wise, three properties maximum. All right. Let me back up and just go into the second rule. It'll make a lot more sense than the identifying. Let me jump to, you have 180 days to close. And this is from closing to closing, from recording to recording. I have 180 days. Again, the IRS is lazy and can look at that and say recorded public document, recorded public document. If it's more than 180 days, doesn't matter if there was a holiday, a weekend, doesn't matter. Okay, calendar days, period, 180 days. End of story. And if you're beyond 180 days, they'll kick it out and you pay the taxes. So it's critical. This one's critical. This one's a little bit less so, but it's there still. So I like to look at this backwards and say, whatever I close on here has to have been identified within the 45 days. Okay, it has to be on my list. All right, whatever that is, it has to be on the list. Doesn't matter within that 180 days, when it closes, it has to be on my list. Now, if I actually close within 45 days, the closing actually counts as the identification. The smart, especially in this market, the smart agents are the ones who are, when this is under contract, clear over here, they're saying, I better be looking for that replacement property earlier than later. I don't want to get in a bind where I'm making silly, stupid offers on property on day 44. Offers that I shouldn't be making. All right. Those offers should be made over here saying subject to my closing here, then I can close any time after that. But you're looking, you see the wisdom in preparing for the exchange before the closing of the exchange of the first leg. All right. So you as an agent, you need to educate your sellers that they need to be very proactive in finding a replacement property or properties. Okay, critical. All right, so those are the two time frames that we're looking at. Let's get back to the methods of identification. So you've got the three properties, unlimited value. You've got the unlimited properties that can't aggregate more than 200%. So it's not really unlimited because you kind of run out of 200% pretty quick. But if I sell my 600,000, I can replace or I can identify $1.2 million worth of property. So if I'm buying a bunch of little teeny, pieces of land or whatever, and let's say there's 7 of them, and they're each worth, $150,000, $120,000 each. Okay, that's the only way I could identify that is by going the unlimited property under 200% of the value, okay, of what I sold. Okay, rarely used, almost never used. All right. The third way, which is almost never used, is unlimited property, unlimited value. And the reason it sounds great because you have no restrictions. They call it a 95% rule, and it's a little bit of a misnomer because it's really a 100% rule. If you can identify as many properties at whatever value, but if you don't close on any of them, none of them work. So this is one that you absolutely put together beforehand. You actually close them the same day as you're closing your sale, so that if one of them falls out, you don't want the whole thing to not work. And so it can work. It's a big gamble unless you're really prepared at the closing time. All right. And I'll walk your clients through all of the pitfalls, all of the risks involved in the identification process, as well as just the general 3 rules. But most of the time, and I include in my 1031 documents not pre-filled out, but a form that allows them to do 3 properties. You fill it out. And that's the other question. How do you identify? Who do you identify to? All right. The most common is that I get either my form back, I get an email, I get a letter, I get something that shows from the client that shows you identified the property. in the time frame. Okay. So that's the identification. Any questions on identifying property? Let me ask one of your questions that you're thinking about. All right. So let's say I put together 3 properties within the 45 days. Well, day 35, one of those properties disappeared. All right. I've already given you you've already given me the list. One of the properties they decided not to sell, or we thought we had it, but it slipped away, whatever the reason, I'm down to 2. Am I sunk? Am I stuck? The answer, no. I still have 10 days to replace that one with another one. So it really doesn't matter along the way what comes and goes and comes and goes in that identified list. What matters is on day 45, it's set in stone. At that point in time, you can't change. All right. So that's the identification. Any other questions besides the one I knew that you were asking but didn't ask?
Alan, on the like property concept, would that work with investing in, say, a real estate investment trust? Maybe I'm tired of all the hassles of hands-on management, or management companies manage my properties. What if I wanted to roll the 100% of my proceeds into a real estate investment trust?
That is a great question. And at the risk of getting a little bit technical, it's still, the jury's literally the jury's still out on some of them. Now, I mentioned that the replacement property, the requirement was that you had to be on title. All right. So a lot of the real estate investment trusts are a tenant in common entity. All right. So this entity is made up of, an example, I got my mother-in-law didn't have any, and father-in-law didn't have any retirement, and they had a bunch of raw ground, non-income producing. So we did an exchange for 30% interest in an O'Reilly auto parts store in Milwaukee, Wisconsin. All right. So they own 30% of this building that O'Reilly has a long-term lease on. All right. But if you look at the title on that property shows them as a 30% tenant in common owner. Okay. That works. Absolutely. What is still kind of undecided is the security people, the stockbrokers and those guys, they're putting together these funds for real estate purchases. And they're saying, well, it's a security, so we can sell them, and it's real estate, so it works for an exchange. The NRA has been fighting that for years now, saying, no, we don't want stockbrokers to sell real estate. I don't know if you feel the same way. I would guess you do. And so that's still kind of in the courts, going back and forth as far as I know. But I know that there are some security REITs, or real estate investment trusts, who are participating in 1031 exchange replacement properties. Okay, so to answer your question, it's being done, whether it's going to hold on. Okay, did that answer your question?
Yes, thank you.
But that's still the concept is absolutely a viable concept. As far as, and a lot of times, if I find a property and I still have money that I'm left over with, that I want to pay taxes on, a lot of times that works great for pigeonholing that extra money into real estate, tenant in common ownership, to where I don't have to pay tax on any of it. Now I have 2 investments, a small tick and the property that I was interested in the first place. So it's a great option. I've got family members involved in 2 of those. Okay, before we move on from the time frames, any other questions on the time frames? One other caveat when it comes to time frames. I mentioned the 180 days. Now, I agree, this is a smart idea. This does make sense for the IRS. The 180 days from closing to closing. The exception to that, which is a bad exception, it gives you less time, is let's say I close on December 30th. And I want to file my taxes on April 15th. Okay, the IRS says this whole transaction, this exchange has to be finished by the time you file your taxes. So if I'm dead set on filing my taxes here, I have, what's that, 3.5, a little over 3.5 months. So let's say 100 days. We just shortened it from 180 to 100 days because of filing taxes. And it makes sense because the IRS wants it all in the same package. They don't want to have multiple years on one transaction. And so they're saying, if I sold something in 2020, I want it to be part of your 2020 tax filing. Okay, actually makes sense. All right, I don't want it to go to the next year. I found out this rule the hard way. Early on, I did an exchange for my in-laws. And it was kind of an end of the year closing. And it was, I found out about the 16th or 17th of April that they hadn't closed on their replacement property. And I was panicking. And I called up my father-in-law. I said, have you filed your taxes? And he said, no, I filed an extension. Okay, saved my bacon back in the day. Because they didn't file the taxes, and so that got extended then to the full 180 days. It's all about filing your taxes. And so if your client is in the process of a 1031 exchange that they close at the end of the year, you need to emphasize how important it is not to file your taxes until they have the replacement property purchased, properties or property purchased. Okay, does that make sense? Kind of crazy, but it's just a technicality. And I will be very much involved with that. If one of my clients closes at the end of the year on their sale, I will also make sure they understand not to file their taxes before they close on their replacements. Okay. All right. So we have the time frames. What are we doing for time? All right, so we have 45 days, 180. The big one is intent. Okay, I get in trouble all the time with my wife because a lot of times I'll say something with the intent up here and she'll take it as the intent down here. I'm sure that doesn't happen with you guys. But intent in a 1031 exchange is absolutely critical. And why I say that is the IRS is, again, bless their hearts. I think somewhere in the Constitution it says something about innocent until proven guilty. I don't know, like it's been a long time since I had civics in high school. I think that's in there somewhere. The IRS doesn't quite believe in that. So when the IRS comes after you, you are guilty until you can prove yourself innocent, right? Hopefully none of you have been through an audit. Hopefully none of you ever have an audit, but that's the stance of the IRS. You are guilty, prove yourself innocent, all right? And so if the IRS comes to your client and says, we don't think this fits, we don't think your 1031 is a valid 1031, then it's your client's responsibility, and hopefully their tax preparer, and I get involved sometimes, to prove them innocent, that they did all the rules correctly. All right. The biggest rule, the biggest thing that they're looking for with intent is the like kind property. All right. If I sold my duplex and I bought a lot, beautiful lot, say I bought a $600,000 lot with my 1031 exchange, or I did a construction exchange for less. But bottom line is I've got house plans all drawn up. I've got, you know, my house, I'm figuring out how much it's going to sell for. And within, you know, as soon as I close it, I'm getting building permits. I'm starting construction as soon as I can. As soon as it's finished, I move into it. Okay. Can I justify that I bought that lot as an income or investment property? No, I really can't. Because my intent, evidenced by my actions, showed that I was buying it as a primary residence. All right. So let's go to the fringe a little bit. Let's say I want to buy a $600,000 cabin up at Brighton. Okay. Now, my real intent is at the end of the day, I want my family to enjoy this cabin up at Brighton. Okay. But I'm using 1031 money. So technically speaking, now it doesn't work. Can I show the IRS my intent is to use this as an investment income property? And this is where it gets a little bit into the weeds, but the bottom line with exchanges, and this is probably something that's very critical that you remember, you can almost accomplish whatever you want to do by knowing the rule and knowing how to work the rule. Okay, that's why rich people pay relatively small taxes, not because they're dishonest, but because they know the rules and they know how to work the rules. And so with this intent rule, if I'm buying a cabin, how do I show the IRS my intent is to income or investment property?
So can you turn it into like an Airbnb or yeah, something like that?
Yeah. So I rent it out. So, and the easiest way to show the IRS, excuse me, what your intent is what they get every year from you. Okay, they don't have cameras showing, you know who's going in. Is that family or is that a rental or who's going into Ben's cabin up at Brighton? It'll probably come to that, but it's not quite there yet as far as Big Brother. But what they do have readily available at their fingertips is your tax returns. Okay. So if I'm showing for a couple of years tax returns, income from my rental, depreciation on my rental, what does that show my intent was when I bought my cabin at Brighton? Right? It shows that my intent was to rent it out. Now, after a couple of years, can your intent change? Can your usage change? Absolutely. Okay. The IRS, the basic rule of thumb for the IRS is a 2-year period. I narrow that down. My rule of thumb is 2 tax returns, which could be actually as little as a year, maybe a little bit less. If end of the year, I show income depreciation, first of next year, income depreciation, and then I sell it or change the use. Hey, my intent was evidenced in my tax returns. But that's what intent is all about, is the IRS is going to try to prove that it doesn't work. You have to prove that it does work, your intent. Okay, it's a little bit fuzzy, but again, the more evidence you have on your side, the better prepared you are for any kind of an audit. All right, showing the intent. All right. Now, if I buy something and I want to use it, the cabin, can I use the cabin during those first couple of years? The IRS's rule on it, again, there's some misinterpretation. The IRS rule says you can use it for 10 days a year personally. Okay. But then they come out and say, we'll give you another 14 days a year for maintenance. If you need to stay there to fix it up or whatever, we'll give you that. Not everybody agrees that you have the full 24 days. But again, is Big Brother really watching that close? I don't think so. But the rule is pretty stringent, and it all comes down to what your intent is in purchasing the property. And this is a little harder to do when you're buying raw ground or land that's not income producing. It's a little harder to prove on your income taxes that you bought it for an investment. All right. Time is what your best evidence is. Okay. Do I have it in this status for an amount of time? The shorter the amount of time, the less evidence you have. But let's say I buy a piece of property in Draper to rent out. All right. And then I get transferred back east for my job. Well, I don't want to be a long distance landlord. And so if I have a story that says, you know what, my circumstances changed, I need to sell this or change the use of it before the 2 years, you know, I feel comfortable with that evidence that I had a reason that I needed to sell before the time frame or change the use before the time frame. Okay. Any other questions on intent? Okay, the next is that it needs to be the same, and I'll go over here, the same entity. And what that means is if I own a piece of property in my name, I sell it, I need to buy the property in my name. All right, if it's me and my wife, we need to buy it together. If it's an LLC, the LLC needs to buy it. If it's a trust, the trust needs to buy it. If it's a corporation, the corporation needs to buy it. So same entity out, same entity in, which creates some problems a lot of times when partners decide to split the sheets and say, you know, we own this property together and we really don't get along. How can we that's a felony again. We don't avoid taxes. How do we minimize or how do we defer the taxes and still go our separate ways? And there are some ways to do that. My understanding is it's not a taxable event if we take it out of the LLC and deed it to ourselves individually or in different LLCs, as long as it's the same people. It's not a tax. That's not a taxable event. At that point in time, we can take our separate tenant in common estates and go our separate ways with exchange or without exchange. It doesn't matter. We're our own entity at that point in time. But the bottom line is there's only one exception to the same entity rule, and that is the IRS treats a single member LLC as the same as the person. All right, so if I have Alan Stallings, I own this piece of property, but I want the new property, I want to buy it in Life is Good LLC, which is one of my LLCs. All right, I can do that because I'm the sole member of that LLC. That works as far as same entity. If there's more than one person in that entity, it doesn't work. After the fact, I can add people to the entity. It just during this transaction, it has to be the same out, same in.
So that includes like your spouse. She cannot be a part of it. Correct.
Yeah. Okay, and then lastly, just any boot is what they call it. And that just refers to any cash you touch or any property that you don't replace. So let's say in our $600,000 scenario, we only replaced 500,000 of it. And let's say we had a loan of 200,000 that we were going to replace. So now our loan is only 100,000. All right, so we have $100,000 worth of boot in our exchange because we didn't do the equal or greater. Even though we didn't touch any of the money, we didn't do equal or greater value. All right. And so on that $100,000, it doesn't negate the whole exchange. The exchange still works. What it means is we pay capital gains taxes on the $100,000 on whatever that increment or whatever that amount is that we don't use. As far as the rules go, we have to pay tax on. Okay. Sorry, I thought I had some questions.
Can you give another example on the boot? Just because I didn't get it the first time. Can you give another one, please?
Okay. So it's boot if, let's say I own the property outright. I own the 600,000. I don't have a mortgage, so I have to replace 600,000. Again, if I replace it with 550,000, I have $50,000 of cash that I end up with in my pocket. All right. So I have to pay taxes on that 500,000, or no, on that 50,000. I have to pay tax on that. All right. Another example is, and this is where it kind of comes into play with you, the agent, and that is where you're making an offer on a piece of property, and you want to be aggressive, and so you have $50,000 earnest money. Okay. Now, normally when you're writing an offer, you go to your client and say, I need 50. Well, let's make it more reasonable. Let's say $5,000. $5,000 earnest money. You normally go to your client and say, write me a check for $5,000 for earnest money as we write this offer. Okay, norm. In a 1031 exchange, if you write that earnest money and it becomes a credit as part of your settlement statement, if you get reimbursed that earnest money, that's considered boot, and you would pay taxes on the $500 or on the $50,000, on the $5,000, whatever the earnest money is. You would pay taxes on whatever you pull out because you're touching the money. Anytime you touch the money in this transaction, you pay taxes on it. Okay. Does that help? It's just
Yes, thank you. I appreciate it.
yeah, I think everything fits into that kind of scenario. Whatever, as far as the value and the money, is all about the boot. If you don't satisfy the money, the value, it's boot. If you don't satisfy the equal or greater value, it's boot. Okay. Now let's talk about a couple of options then, because you're going to have a client that says, oh, you know what? I really wanted a brand new Tesla, you know, one of the $60,000 ones. And so I'd like to take 60,000 out. So their options are, they actually have three options at that point in time. The three options are they take $60,000 in boot. Well, at that point in time, they would have to take probably 75,000 in boot, pay taxes on the 75, end up with 60,000 to buy their Tesla. Okay. Which is, most people do that because they don't know anything else. Another two options are, before I sell my $600,000 duplex, I already know I want to buy a Tesla. And so I pull a home equity line, or I get a cash out, refi, or whatever on my duplex, $60,000 home equity line. I go buy my Tesla, then I sell my $600,000 duplex with a $60,000 loan on it, and then after that, I replace that loan with in the replacement property. Okay, but I have $60,000 of tax-free money to buy my Tesla. Bottom line. Now that almost never works because usually you haven't talked to them by the time they're ready to sell. And once they have a for sale sign, or once it's listed on the MLS, lenders are a little less likely to lend that $60,000 on a listed property or on a property that has a for sale sign on it. So normally that option doesn't work. And so usually the next option is after the fact. After the dust has settled on the 1031 on the replacement property, now that you have a ton of equity in this replacement property because you put all that equity from the duplex. Once the dust is settled, then you go to the bank and get a home equity or whatever, $60,000, go buy your Tesla, tax-free $60,000. Okay. So it's, you're saving $10,000, $15,000 for your client just by knowing that if they wait or if they plan ahead, they can do it tax-free. Okay. Again, I only point that out just to show how smart I am. No, I'm just kidding. I pointed out because if you understand what can be done, you can accomplish a lot of things that benefit your client. Okay? So it's all about knowing how to structure things to the best advantage of your clients. Okay. Any questions on, and I'm sure you probably do, any questions so far on our rules? We'll get into a couple of different scenarios in a second, but before we do that, any other questions?
Do you do reverse 1031 exchanges?
Oh, way to be ahead of the curve. Way to steal my thunder.
I just heard about them recently, and I think that sounds amazing.
Yeah, let's just jump into that right now. Okay, a reverse exchange. So we talked about the time frame. We sell, 45 days to identify, 180 days to purchase. Okay, that's a straightforward normal exchange. All right. Reverse exchange, what would you think that is? The reverse of that, right? All right, so John Thornton has gone out and found a killer deal. He's got a property listed, but it's not going to close for 3 months. All right, but he came across this steal of a deal that has to close in 30 days. Okay, but it's too good to pass up. It's like, oh, I wish we could do an exchange and have it, I wish we could move the one closing and the other client. Not going to work. It's just nobody's going to cooperate with us. And so what John can do, if the clients have the resources to do it, and that's a pretty big if. So if they have the ability, whether it's through borrowing or savings or whatever, if they have the financial ability to close on the purchase, the screaming deal, before they have the funds from their sale, then we can purchase the screaming deal and then close on the sale and then replace it. And there's two ways the reverse happens. The old school way is that the accommodator, again, single purpose LLC, is set up to take title with your money, with your client's money, to the screaming deal. Okay. The problem with that scenario is the financing. No financing company wants to lend money to a brand new LLC. Okay. So that was really tough unless it was a cash deal. So the more common now scenario with the reverse is that my single purpose LLC acts as the buyer on your sale that's not going to happen for 3 months. Okay. So I become the seller with a trust deed and note for whatever the proceeds would be estimated to be. Okay. So on paper, you have closed on your sale. So now it's not a reverse technically anymore. It's a straightforward exchange. All right. I've sold this on paper, which is all that matters. I'm off title. All right. Now I can go and I can get financing because the purchase is going to be in your client's name. So they can get their financing and everything else. And then when it finally closes, when I finally close your property as the seller, then I pay off that note and trust deed. And then the purchase that you did by yourself with financing or without is cleaned up at that point in time. Okay. It's a lot more complex. And so the cost to do the reverse exchange is like triple the normal cost of an exchange, just because of the setting up the LLC, the extra liability, and all the extra hassle with going through it. So you try not to do that if at all possible. And some of the ways to avoid having to do an exchange are to throw extra money at the seller of your screaming deal. If you've got enough money to buy it without selling, you throw 50, 100,000, whatever non-refundable earnest money at the seller, asking them to postpone that purchase. And if it still doesn't work time frame wise after the extension, worst case scenario, you're still back to the reverse exchange. It's not like you've lost that non-refundable earnest money. But what it does, a lot of times it allows the seller then to feel warm and fuzzy about extending your screaming deal closing. Doesn't happen all the time, and you do the reverse exchange, not a problem. Since we're talking about that, let's just jump into the cousin of the reverse exchange, which we kind of touched on, the construction exchange. It's very similar in that I take title to, and this is where, let me give an example of a client I have now. Out of state, he goes in and buys up wholesale properties. And he buys them, fixes them up, and then rents them for a couple of years. And then he kind of fixes them up again and then sells them because they've appreciated. All right, and then he 1031s into another fixer-upper. And so he's selling a nice property, now buying another fixer-upper. And so to accomplish the equal or greater value, he does a construction exchange where I take title with the LLC, single purpose LLC. I take title to that. He pumps his money into that property until it's equal or greater in value. And then I sell it to him at the higher value, making the equal or greater value rule work. Okay. Simple construction exchange. You can do it from ground up. You can do repairs. You can do whatever. Again, it's a lot more complicated. So it's similar in price to the reverse exchange as far as the 3 times as much about as the regular exchange. Okay. Way off into the weeds. There's leasehold exchanges. There's a lot of different options. There's, if I have an airplane and I want to exchange it for another airplane, I can do that. I mean, there's almost endless 1031 exchange possibilities. And we try to limit this to just real estate. And so the reverse, the construction, and the regular exchange are pretty much all you're ever going to run into.
What are the costs for a regular 1031 exchange?
Billions. So the regular cost is, and it varies by company, but they're all fairly consistent. A normal regular exchange is $600 one time at the beginning, at the setup, and no charge. These are my charges. Nothing on the tail end, nothing on the second leg, unless there's multiple properties. I had someone up in Logan sell a multi-million, like an $11 million property, and then they bought like 18 properties with those proceeds. And so after 3 properties, I charged them a per property charge just because, that was fair, reasonable. Normally the $600 covers the whole thing. Okay. On a reverse, it's $1,500. A construction is $1,500 for all the setup and everything else. Okay.
Can I ask you one more question about the construction exchange? That is, do you only have 180 days to complete the construction and go ahead and do that deed over from your LLC?
We talked about that, and I said that's the biggest obstacle with a construction exchange. And that's interesting. Again, not to go off in the weeds, but we will. I'm a golfer. I'm usually in the weeds. Let's say we sold our 600,000, and we bought a $300,000 lot. Okay, I have 180 days to put $300,000 more into that property. Okay. Now, the IRS changed quite a few years ago. It used to be that had to be finished, C of O, everything had to be done with that property within the 180 days. And they loosened that rule a little bit. And now they say, it's not going to be a $600,000 house. It's going to be a $900,000 house or property. let's say duplex again, all right? What do I have to replace? 600,000, right? So what has to happen is there has to be $600,000 worth of value attached to the property within the 180 days. Does it have to be finished? No. Can it be lumber sitting in a pile? No. It has to be attached to the property. So, and there's schedules in building, you know, at a 4-way, it's certain percentage. As a, you know, at, I don't know what else, what other benchmarks there are in construction, but basically the bottom line is they're realistic percentages that if the house is this finished, then it's a percent of the 900,000 works as the value. But the bottom line is number one, it's hard to get financing on an unfinished property. And number two, you have to have a title company that will work with you and make sure that there's not going to be any mechanics liens or anything else. But the title needs to transfer within the 180 days, and the value needs to be on the property, attached to the property within the 180 days. Josh, does that answer? And again, you know, feel free, you've got my contact information. Feel free if you have other questions specific that may be a little bit beyond what we should cover here, please, you know, feel free to call me.
Hey, Alan.
Yes.
We got a lot of people that are concerned about keywords to get the credit here. Is there any keywords that are going to be coming out?
To get what?
To get credit for the CE? I don't know. Sometimes we take keywords as we go along the class.
This is my first online class that I've ever taught, so I don't know if that's coming from me. It's not. If it's something that the instructor.
If you don't know any keywords, no worries. We're keeping track of anyone that's got their cameras on, so we will just count the ones that's got their cameras on the whole time.
That's perfect.
Okay, thanks, Alan.
Well, my babysitting days are over, so that's perfect. Thank you. Okay, what other questions were there?
That was it.
That was it?
Yeah.
Okay. All right, so how are we doing time-wise? Oh, there's a clock. Okay, we have just a few minutes left. The only other restrictions that you need to kind of be aware of is arm's length transactions. All right, a lot of times you have your relative, your brother, your daughter, your son, your parents, whatever, that you're trying to manipulate taxes with. And so on either side, if you have someone doing an exchange, if you're buying from a relative, it has to be held by that relative. If you're selling to a relative, it has to be held by that relative for at least 2 years. The related party rule. All right. If you're buying from a relative, obviously you would want the 2 years just to show intent, but it has to be 2 years as well. So if you're dealing with a related party, it's always going to be a 2-year hold on both sides of that. All right. Now, there are shifting bases, and this is the 300 class. But let's say I've got, let's go back to our 600,000, and let's say our basis is 200,000 and our gain is 400,000. All right. Now, if I'm buying two properties, two $200,000 properties, I'm sorry, that doesn't work. Let's keep it up there. Let's buy 3 $200,000 properties for our equal or greater than 600. All right. What do I do with this basis? Do I have to split it up evenly between the 3 properties? And the answer to that is no. I have the option of deciding where the basis goes in those 3 properties. Okay, as long as I don't try to eliminate the basis, I can spread the basis out into the additional properties as I see fit. Okay, again, flexibility within as long as you know the rules. Okay. I think we've kind of covered. Any questions? One of my main rules when I give a class is, and we started a little bit late, and if we start late, then my rule is we have to end early to make up for it.
I have a question.
Yes.
Is there any way, if you have 10 entities that are in a LLC and you have only half of them want to do a 1031 exchange, is there any way to still do that?
Okay, say again. There's a little bit louder, Benson.
Okay. If I have a LLC that has 10 members and say 5 of them want to do a 1031 exchange as they sell this property, the other 5 do not want to, they just want their cash. Is there any way at all that you could still do a 1031, or that those 5 could still do a 1031 in that sale?
Yes, there's 2 ways, and one that never works and one that always works. The one that never works is that you still take that entity, do the exchange, and then after the fact, you split up the entity and buy out the 5 that don't want in. That never works because the ones that don't want in kind of don't want to go through all those steps. And so the norm, the best way to do that is before the sale, you disperse basically on paper. So instead of, let's say, ABC LLC owns this with 10 members, okay? What you do is you know, B owns now 10% tenant in common. C ends up 10% tenant in common. All those 10 members get their whatever percentage they are of that LLC. They get deeded a percentage of the property. So they're still entitled, but only as a tenant in common ownership. Okay. At that point in time, it closes. Then everybody, all of those 10 people can go off and do whatever they want to do. The other option is that the 5 that don't want to do it sell their interest in the LLC to the 5 that do want, and then we keep the LLC in place, and the 5 that want to do it together go and do it together after the fact. So those are basically the two main ways to get around that, Benson.
Thank you.
Any others? Okay, the most important part of this whole class, well, okay, 2, is you have a basic understanding of how it works, which I think you probably do. Hopefully you do. If you don't, call me and we can go through whatever, you know, that you want to go through again or other questions. The most important is just that you've got my contact information, that you or your clients can call me with any questions. But, you know, be nice to the escrow officers here and try to take care of that before closing, so that we're not panicking at closing as far as jumping through those hoops. But it's a great, the advantages for the agent, which is probably what we ought to end on. We talked about the 2 sales, at least sale and a purchase, almost guaranteed. Cash is king. We all know that. Unfortunately, a lot of out-of-state cash is coming in, diluting the cash is king thought. But the issue is, if I'm going into a property with a chunk of change for my exchange and a time frame that I have to close, especially if I'm beyond my 45 days. Am I a committed buyer? Am I ever going to back out of that deal? Not a chance. Okay, ton of cash available, a time frame that I have to spend it. That's a great offer for a seller to consider. Okay, I would represent that buyer as an agent any day. Okay, so a sell, a buy, a fabulous buyer. Okay, plus you open up to, once you become kind of known in the industry as someone that knows this tool, there's a good chance that you will be referred a lot of different investor types to do the same thing, to save them. If you can save somebody $50,000 or whatever, even if it's 5,000 or 10,000, I mean, that's huge as far as recommendations go for new business. Any other questions?
Oh, I just thought of one. What if you've done a cost segregation? Could you just kind of walk through an example of how you'd add that back in to the basis?
It defined for everybody, mostly for me, define cost rate segregation. What do you mean by
It's
that?
kind of like bonus depreciation, where instead of spreading it out over 27.5 years, you can go to a cost segregation study. You used to have an engineer, but now I've found software. I'm actually just getting ready to do my first. It's like $400, and they'll break out the land versus the building. So it's usually the land is 20% and the building is 80%. And then instead of waiting all those years to get all that depreciation, you can get a big chunk of it. They'll break out all the elements, and you can do a massive depreciation up front, especially if you have a big tax bill coming up. You can like wipe it out with that, getting all that depreciation up front. A lot of people call it bonus depreciation.
Accelerated. So it really doesn't change the scenario. It just speeds it up. So all it's doing is shrinking your basis even faster, so that your tax liability is bigger faster. Okay, so it really works for the here and now while I've got this property, because of all those write-offs, that big write-off. But at the end of the day, if I'm gonna sell it and buy something else, it motivates me more to do the exchange, because now my tax liability is that much higher, especially with the set 25% recapture tax in addition to the capital gains. Okay, but it doesn't change the scenario as far as the rules or the process or anything else. It's a huge advantage in the here and now, and it just makes a lot more sense to do the exchange down the road. Does that, I don't know if that answers your question.
Yeah, no, that's a good point, that it makes it just even more important to do it. Okay.
Yeah. And again, when people pay taxes, it's like, good for you. I love this country. Pay them. I just don't want me or my friends or clients to have to shoulder all that burden. Just don't tell the IRS I said that. Okay, any other questions? Give me a call and we'll talk about it. But hey, appreciate your attendance and your attention. Have a good one.
Hey, did everyone need something? All right, thank you everyone for joining the CE class. Does anyone have any last questions or anything? Okay, thanks for coming, you guys. We will get your CE certificates out and let us know if you need anything, okay? Thanks, you guys. Have a great day.